Bill Black.
Hello, everyone. I'm Bill Black. I'm a Vistage member and speaker, and I'm happy to host the latest webinar in the Peak Performer series. This webinar series is designed to support your leadership climb by bringing the most trusted experts to the Vistage community who provide exceptional insight and best practices to help you navigate new challenges and possibilities. Today's webinar is Goodbye Capital Gains Tax. Is 2021 the year to sell? We've invited Bob Hild, Chairman and CEO of ACT Capital Advisors, to discuss the future tax situation and how it will affect you, especially if you're a business owner who's considering an exit in the next few years. Let me turn it over to you, Bob.
Thanks, Bill. Thanks, Mary Jo and the good folks at Vistage for this opportunity to share our insights about capital gains and how they might impact the value of your business. Greetings today from beautiful sunny Seattle, which means if it's sunny here, it's probably not so sunny where you are. I hope you're enjoying your spring. It's going to be 75 degrees here today. The cherry blossoms are out, the daffodils and so forth. It's a gorgeous day. I was just on the phone with a client from Denver, and I feel sorry for your folks in the Denver area, as I guess winter is still hanging on for one last day of snow. So with that said, I would like to begin this morning. The topic is Goodbye Capital Gains Tax. Is 2021 the year to sell? I thought I'd start today by discussing what I hope you'll take away today. We're going to discuss a number of topics, including the one in the title. We're going to also provide some additional information in and around that topic. So we're going to talk a little bit about the current state of the M&A marketplace. We'll talk about the proposed tax changes and their possible impacts upon value. We'll talk about how your company may be worth more as we come out of this post-pandemic world. We'll talk about how you might be able, what steps you may be able to take to enhance the value of your company as you prepare to exit. And lastly, we're going to have a Q&A session, panel discussion and Q&A. So begin with let me give you a little background on what's been happening in the M&A world. Of course, last year, 2020, was quite a shock to the economic system. We for the first time in our history, had a self-imposed recession. And we can see that activity, how it impacted M&A transactions. You can see here, if you can see my mouse, you can see this is a second quarter of 2020, where you see the volume of M&A transactions precipitously dropped in the second quarter. But what's interesting is as you look at what happened in Q3 and Q4 of last year's Q4 hitting all-time highs. So let me just tell you a little bit anecdotally what happened over 2020. I can first start by just sharing our own personal situation. Our firm on average closes somewhere between 15 to 20 transactions per year. In the first quarter of 2020, we had 7 transactions lined up for closing when the pandemic hit. Of those 7 transactions, only 1 closed in the second quarter of last year. And then we didn't have any closings until September of 2020. We had 1, and then we had 6 additional closings in the fourth quarter of last year. Now, of those 7 transactions that were to close in that first quarter, 1 of them did close. 2 of them completely fell apart. The pandemic had such negative impacts upon either the buyer or the seller that there was no way to salvage the situation. The remainder all got postponed and eventually did close. So that's why you see a lot of this boomerang here. There's really a lot of deals and transactions that were lined up or were prepared to close, were delayed and ultimately closed in Q3 and Q4. And primarily, again, because by that point in time, corporate boards, economists, financial folks now started to see the impact of COVID, and also to begin to see the light at the end of the tunnel, how we're going to see ourselves through this economic situation. And so optimism began to seep back into the M&A market. Now we're going to take a look at another statistic here. Many of you may be familiar with the term EBITDA. EBITDA stands for earnings before interest, tax, depreciation, and amortization. Another way to look at it may be the true cash flow of the business before tax. And in our industry, we tend to use what we call a multiple of EBITDA in determining and looking at valuations. And that multiple is just basically taking the enterprise value or the sale price of a company and dividing it by EBITDA or cash flow to come up with this multiple number. So you can see here how multiples changed a little bit in the second quarter on the far hand right side of the graph. Second quarter of Q2, you see for companies, and this graph here is for companies that we call the lower middle market. Those are companies with sales or revenues between 5 and 50 million. Okay, and so you look at that group, you can see that the multiples dropped significantly from Q1 to Q2 as the pandemic set in. Maybe those that ultimately closed were a little more desperate to do so, and were willing to take discounts in order to close. But then you see a rebound in the EBITDA coming back in Q3 and Q4 normalizing. So we see that the multiples or valuations have normalized in the third and fourth quarter of last year. Now, EBITDA multiples are not the same by industry. There's a lot of factors that go into an EBITDA multiple. A lot has to do with the industry, the risk, the upside potential in those industries, individual risks of different businesses, so forth, all get factored into this multiple of EBITDA. So if you look at it by industry, there's no surprise here when you look and you see the technology industry had, despite a down economy and fewer transactions being done, the outlier were technology companies. And they were a hot sector, still remain a hot sector. You can see the multiples jumped from 11.3 to 19.1. Now, that's primarily because a lot of these technology companies are what we call SaaS models, so software as a service models, which have very, very high margins and also can have platforms that can expand very quickly. And therefore, their values were significantly higher. But you look at some of these other industries which were hurt during the pandemic. If you look over here at the healthcare and social assistance sector, it dropped from 6.0 down to 3.5, basically because of the unknown of how COVID was going to impact that industry. You can see here other industries that also suffered likewise. You can also see that the average for companies with a 5 to 50 million in revenue, the average EBITDA multiple is 4.4. So what factors today are driving the market, the M&A market? Well, certainly we see the light at the end of the tunnel. So we're seeing an improving economy. We see that in today's stock market, and the Dow Jones is hitting all-time highs, and NASDAQ as well probably closed this today at all-time high levels. The Dow Jones is above 34,000. So those are those are leading indicators. The stock market is generally a leading indicator of how people or forecasters are looking at the markets in the future. And so the fact that we have a high stock market at this point in time tells us that the economists and financial folks are looking at a very strong recovery. Okay. The other thing that's driving our industry is what we call dry powder from the private equity firms. Now, private equity firms, for those who are unfamiliar, are organizations or groups of investors that invest specifically in privately held companies. And so these private equity firms, and there's many of them now, they have become a plethora of them over the last 15 to 20 years. And they go out and I used to be a partner in a private equity firm for 25 years, so I have a lot of experience in this space. So they go out and they raise large sums of money in advance, and then they go out and make these acquisitions in privately held companies. Now, what's interesting today is the private equity world has 1.7 trillion, that's a T, folks, $1.7 trillion of dry powder. That's capital they have committed that they have not yet invested. And they need to get that money invested. They're getting a lot of pressure from their limited partners to get that money invested. They need to get it invested sooner than later because of the time value of money and being able to get the returns they're going to need to demonstrate to their limited partners they have to get that money invested, and they have to get invested soon. I'll show you another graph later on to demonstrate this a little bit more. Additionally, on top of the private equity, U.S. corporations have $4.0 trillion, $4 trillion. That's hard to say. $4 trillion of excess cash. That's cash that's beyond what they need for working capital purposes. This is investable cash. They have to figure out what to do with that cash. They either have to distribute it in dividends, stock buybacks, or look at investing it in operations, or what most are looking at doing, and we'll talk about that in a few minutes, but 73% of corporate COOs have said they're investing, they're going to be investing that money and looking at M&A transactions. So roughly 73% of the U.S. corporations anticipate doing acquisitions over the next 12 to 24 months. Okay. Another thing that's driving the economy and the M&A market is low interest rates. The federal chairman of the Fed, Jerome Powell, went on record about 30 days ago stating that they will hold interest rates, Fed rates, at or near zero for the next 2 years. Okay, next 2 years, we're not going to see that increase. That doesn't mean they won't change their policy, but that's what they're forecasting at this point in time. But those low rates allow for lower borrowing costs for private equity firms, for companies, for corporations, increases profitability, etc. Those are all another reason why we have this tailwind or wind in our sails right now in the M&A market. Lastly, it affects kind of I call it the supply side of the equation. We have aging baby boomers. I'm one of them. Maybe there's some of you on this call as well. Now we're getting to that point where is it time to exit? Is it time to sell? Is it time to enjoy to take the chips off the table, take that risk out of our lives, take that basically guaranteed money that we can take today and secure our retirements, and maybe help secure our future and that of our children as well. So here are some quotes from some of the industry experts, just to give you a little additional background of what people are feeling about the 2020. Stuart Cole is co-founder of Riverside Companies. They're one of the largest private equity investors that invest in this space. And he says, I'm bullish about 2021, especially for companies who performed well through COVID. We'll talk about that a little bit more later too. Then we have a quote from Heather Madeline, a partner in Huron Capital, another private equity firm that's very active in our space. And she says, baby boomers have lived through 3 cycles, this pandemic included, and they are ready to sell. COVID is getting would-be sellers off the bench. So are taxes, by the way, and we'll talk about that in a minute as well. And then lastly, we have a quote from Graham Fraser. I know Graham, been to a number of his presentations over the years, and this is his quote. He says, I have a positive outlook for private equity and M&A activity. The amount of investable capital out there is gigantic catalyst that is not going away. The scarce resources, the number of deal opportunities that are worthy of an institutional private equity capital. And we're going to talk about some more of that in just a minute. But with all the tailwinds in our sales, there is a headwind. And that headwind is one 5-letter word, or maybe it's a 3-letter word, whether you want to use it singular or plural, and that's taxes. We're gonna, as one president, as presidents of both parties have said, elections have consequences, and no, that is no truer than the recent election. The Biden administration made it very clear during the campaigning the taxes were going to go up. The corporations weren't paying their fair share, or the wealthy weren't paying their fair share, and we're going to do away with the Trump tax plan and implement their new one. And so they put forth their new tax plan. We'll talk about a little more in detail, but it includes corporate taxes, increasing individual taxes, and elimination of capital gains above $1 million. So let's talk about these tax changes a little more in detail. So under the proposed Biden tax plan that they put forth to Congress, is they want to see the corporate tax rate in the United States go up from 21 to 28%. Okay. They are proposing the individual tax rate go, the highest rate, go from 37% to 39.6% for those earning combined incomes of over $400,000 a year. Capital gains rate. Under the current law, the capital gains rate is 20%. Then they tack on an extra 3.8% for the investment income tax credit, or income tax, excuse me. So that's another 3.8% it gets tacked on. So it's a total of 23.8%. The Biden plan is going to allow for only capital gains only on the first $1 million of capital gains in a given year. Anything above $1 million is going to be taxed at ordinary income. So if you're one, if in this case, that would put you, assuming your company sells for multi-millions of dollars and you have multi-million dollars in capital gains, that means anything over $1 million will be taxed at ordinary income tax rate, which they're suggesting will be 39.6%. So how might this play out? So I thought I put a little example. We're going to use this little example here for the next couple minutes, kind of walk through it so you can understand the impact of the loss of capital gains tax for most small to medium business owners. So let's just assume for a minute we have a company X, that sells for $10 million. Assume that you have a basis in that company of $1 million, and that's that's the amount you put in. That's your basis, your tax basis. So your proceeds are subject to capital gains is just the 10 million minus 1, so it's $9 million. That is now subject to capital gains. Under the current tax system, that you get taxed 20% for capital gains plus the extra 3.8%. So in this situation, you'd have a tax bill of $2,142,000 under our current tax system. Under the proposed Biden changes, with you paying now individual tax rate above $1 million, your capital gains tax is going to be basically $3.5 million. Add in another $342 million for the excise tax. You're now at $3.9 million in taxes. So you've gone from 2.1 to 3.9. That's a whopping 82% increase. 82% increase in your capital gains tax. Okay. Now let's look at it. What does it mean on this next slide here in total dollars? This is basically the same scenario. Now you take the capital gains tax. How much do you actually walk away with? Which is, everybody wants to know. I mean, what is my takeaway? What do I get to stick in my pocket after I pay off Uncle Sam? So in this transaction, you would have, under the current tax plan, you would be able to pocket almost $7.86 million. Okay. Versus the Biden plan would only be a little over $6 million. So as you see, the deal proceeds decreased by 22.5%. You get to take home 22.5% less cash under the Biden plan than under the current plan. And this isn't lost on corporate America either. This is a little slide I threw in here, prepared by CNBC. And this has to do with basically Fortune 2000 companies and what their perceived impact is going to be on their stock value. These are publicly traded companies, so they anticipate that once these Biden tax rate, an increase in rate for corporate taxes and capital gains taxes go into place, that we'll actually see a downward pressure on the valuation of stocks in these various sectors. Technology as much as 9.2%, down to financials, we'll see a reduction in their stock price of 6.5% as a result of these taxes. Okay, let's talk for a minute about, okay, so we're coming out of this pandemic. Why might my company be worth more post-pandemic than pre-pandemic, even given some of the negative headwinds with taxes? As I mentioned earlier, there's a demand problem. There's so much capital available. As you look at this graph of private equity firms, that blue mark is the amount, the upper blue range is the amount of it that they have actually invested, and the bottom one is how much they have in dry powder. And as you can see, how much is still left yet to be invested is a huge sum of money. As I mentioned earlier, 72 business executives believe M&A will be a leading strategy for post-pandemic. That's up from 32% prior to COVID-19. So that's a more than doubling. So corporations are now looking at this opportunity, seeing what's coming out of the pandemic, and they're going to rush in and pick in order to gain revenue and market share and to better solidify their positions in key markets they want to be in. They are going to go on a buying spree, and this is the time to do it. They've got tons of cash, and there's a plenty of companies that will be coming on the market eventually to be bought. So that's why you see this strategy of corporate America doubling the number of companies that are going to look at M&A as a means of growth. Okay. As I mentioned, 89% of the PE firms say they're going to be as aggressive, if not more aggressive, than they were pre-pandemic. That's because they're sitting on so much cash. They've got to get that money deployed. As I mentioned earlier, corporations have over $4 trillion of cash to work with. Now, the challenging part of the equation, now we got a demand side. We've got a lot of demand for companies, but the hard part is the supply. There are actually fewer quality companies on the market today. Many of them are sitting on the sideline. Many of those who were considering going to market in 2020 have shelved those plans, and they're sitting on the sideline watching and waiting for things to improve. Okay, they're looking to see what the impact of the pandemic will be. They're waiting to see what's going to happen as the economy recovers. They're wanting to see what's going to happen with valuation multiples. Okay, and perhaps their own business is going through its own post-pandemic recovery as well. So they want their own performance to have improved or to demonstrate that they have gotten beyond the recession. So, and the other thing that's keeping quality companies off the market is this belief that only desperate companies are in the marketplace today to sell. So we've got this, what's happened is we've got this dichotomy. We've got tons of capital to be deployed, but fewer quality companies. Back to a Graham Fraser's quote that I mentioned earlier, fewer quality investable opportunities, but lots of capital. When you have those two come together, it's going to create higher valuations for the quality companies. Now, another thing that's going to happen, I think, as we see and we see this happening in our own company as well, in our own business, just doing anecdotally, as I mentioned, we normally close 15 to 20 transactions. Last year, in the third and fourth quarter of last year, we took on 34 new clients. That's far in the record. We closed 80% of those. That's our record. So we took on 34 new clients in the third and fourth quarter last year. First quarter of this year, we've taken on 18 new clients. Now, we foresaw what was happening, and we predicted that we'd see a tremendous rebound in the M&A world. So while many of our competitors were downsizing their staff, we actually took those PP monies that we received and we doubled down. And we've doubled our staff, doubled the size of our office space, et cetera. So we are prepared to handle that increase in volume of business, where many others are going to be struggling to do so. But why we are able to take on 18 is most of those 18, I can tell you, came to us because of the capital gains issue. Okay, they were vacillators. They've been sitting out there for the last year or two thinking, is time right? Is it right or not right? And all of a sudden now, after the election, our phone's been ringing off the hook. And not only do we have 18 new clients, we probably have about 10 more right now that we're having engagement agreements outstanding that we are in negotiations with. So we are seeing that tipping of the bucket now. So let's talk about, this equation of a quality company being of high worth in the business and in the M&A world right now. And let's talk about what makes a quality company. First thing that's important, coming from the private equity world, we always talk, our mantra was management, management, management. Those are the three key things that are most important in an acquisition. Okay, having a solid management team. Now that may mean that in your case, you want to retire or you want to move on. So as you do so, it's important to make sure you have a strong secondary management team that can run the business pretty well in your absence. Okay, if you can do that, then you will grade highly under the management team sector. Okay, but very important to develop that secondary tier beneath you of the management team. Okay, second, what's your growth potential? What's your scalability? Can your company scale? Does it have good growth to it? That's important. Have you created barriers of entry to your business? Do you have such as patents or technology, or have you strengthened a position geographically where you're the market share leader and it becomes very difficult to compete with you or in that sector? So you want to look at ways you can put a moat around your business and create barriers of entry. If you can do that, you will add more value to the business. Do you have a trend of increasing profits and increasing margins? Are you reaching a level of scale where the marginal revenue far exceeds the marginal cost? Okay, that's attractive again to investors into PE firms. This is actually should have been probably the number 2 item on this list, because probably the second most important, the one we see quite frequently as a stumbling block for clients, and that's customer concentration. And hey, I get it. Most of you started your businesses because you had one client who really wanted your services, and you grew with that client. We see that a lot here in Seattle. We've had a lot of clients over the years that do business with Microsoft, and they became so good at it. Many of them started off at Microsoft, left, started up businesses to sell and supply and service Microsoft, and they've struggled mightily to expand outside of that Microsoft window. And so I get it. It's hard. You get into a client, you keep expanding with them, and it's hard to diversify. But customer concentration is a huge, huge problem. And if you have customer concentration, you got to expect that you're going to sell for a discount below the average median EBITDA multiple for your industry. Okay, recurring revenues. So is your revenue stream a recurring revenue? And I like to use a little story. I was doing a regional executive summit for Vistage in Salt Lake City about 2 years ago. And part of my presentation, we were talking through these value enhancing qualities, and I got to recurring revenues. And I used an example of an HVAC contractor that we knew that was basically going from one contract to the next. And that's an example of a bad model from a recurring revenue stream perspective, because you're only as good as the next contract. If you can't win another contract, then you're out of business, right? But this HVAC contractor had the foresight to put in service contracts. So now they had service contracts with their clients where they're going back and providing annualized service at a certain cost. And these are usually very profitable, high margin, and they're recurring revenue stream. They're usually long-term contracts, 5 years, 7 years, 10-year type contracts, and they're providing monthly service or quarterly or whatever it might be. Those service contracts are of high value. And it was interesting. I had these 2 kind of rough-looking guys, younger guys in the back of the room. They jumped up, said hallelujah, gave each other high fives, and found out that they were HVAC contractors, and they'd done the exact same. They were just starting and recognized that and had just started doing the same thing. So where you can create recurring revenue streams in your business, it's going to create value for you. Lastly, the big thing is having quality financial statements. Make sure your financial statements are prepared according to GAAP. It's best to have reviewed, audited, or a Q of E, the quality of earnings report, done annually on your business. There's nothing that derails a due diligence process or causes a a retrading of a transaction or the value of a transaction than poor financial statements. If we present financials a certain way, and then they come, you believe me, when the buyer comes in and does due diligence, they're going to bring in their auditors. Okay, they're going to bring in the people, and they're going to look at GAAP, and they're going to look at how you kept your books. And if they haven't been kept according to GAAP, or if there's things that aren't correct in there, they're going to find them. And when they do, you're going to lose a lot of credibility as an organization, and they're going to come back and ask for a reduction in purchase price. And that's a hard thing to swallow when you've already committed yourself emotionally and psychologically to selling the business, and you have a buyer right there, and you're down to the last hour, right? It takes a while to get through due diligence. You're about ready to sign the closing agreement, and they come back and say, hey, we found X, Y, and Z in our financial due diligence, and therefore that reduces our purchase price. Don't want to have that happen. Best insurance policy you will ever have or make in this process is to make sure that you've had your financials reviewed, audited, or if you haven't had those, at least do what we call a quality of earnings report and get that done. That may cost you some money, $20,000 or more to get that done, but it's worth every penny, because every dollar you lose in due diligence, you're going to lose at least that on multiple and then some. Okay. Okay, I thought I'd share with you today what are some of the questions that buyers are asking us, or we're seeing being asked of potential sellers as we go through the process, particularly since we're coming out of this post-COVID-19 situation. So the one thing they're looking for is they want to know how you responded to the pandemic. Did you respond like an ostrich and put your head in the sand and wait for the storm to blow over? Or did you see this as an opportunity to create additional value? Did you see it as an opportunity to increase revenues and profitability? Were you flexible enough, and were you able to pivot? Were you innovative? And how are your customers and your suppliers doing? Are they all financially okay? Because without them, you can have problems. We've seen recently, as a result of the pandemic, the disruptions in supply chain. Some of you may have experienced this. My wife's business, she's an importer of product from Southeast Asia. And her business has been impacted in both the cost and the timing of being able to get products from Asia over to here. And I was reading reports of the LA terminal. There's like 30 some odd ships just sitting in the bay waiting to be offloaded. It's going to take them like 13 days to get through that. So these are causing just supply disruptions. Hopefully, you have gotten through that through that process and found ways to shore up your supply chain if that's the case. Can you isolate the financial impact of the pandemic on your EBITDA? And there's a new term that's been coined in the industry, and it's called EBITDA-C. Okay, with C standing obviously for COVID. How did it impact your business? Was it a temporary impact? And if you can identify those temporary impacts for whether it be cost and revenue side, then we can look at those and present those to a buyer and say, look, we have identified those impacts. And by the way, Mr. Buyer, the company has recovered already, or is on the road to recover. We can see it here, in subsequent months. So what buyers are doing are actually ignoring the impact of COVID, EBITDA-C. And one of the questions I get from clients all the time is, well, do I need to wait a year or so after the pandemic to show a full year of better performance? And the answer to that question is no. If you can demonstrate that your company is back on track, that you pivoted, that you've done certain things to shield yourself against the impact of it, and you've passed that, then they will overlook the COVID negativity, or the negative impact that COVID has had on your business, as if it never happened. Again, part of the reason they're doing that is there's just so much capital that needs to be deployed, and particularly private equity firms, if they can see the lights in the tunnel for you and you're coming out of it, they're not going to negatively impact you for the COVID experience. All right. Lastly, do you have any employee issues as a result of COVID? Have you had any significant downtime? People, have you lost any people as a result? How did COVID impact your business from working remotely versus working in the office? How did you adjust for that? How do you plan to move forward with it? What's the status of your PPP loan? Most of you probably now have submitted for forgiveness. This was more of an issue for us as we came towards the close of the year. We closed those 6 transactions at the end of the year last year. All of them had PPP loans. We had to work through forgiveness issues, making sure A, either we got the forgiveness, or B, we had to maybe leave money in escrow to cover the amount of the debt until the forgiveness was given or the amount was known to be forgiven. Okay. So if now most of you should be able to apply for and get your loans forgiven and get, or at least some portion of it. Best to get that done now before you get into due diligence. Okay. Lastly, and most important, what buyers are looking for is, how are you coming out of the pandemic, and do you have a plan, right? When you pivoted or you created some new innovations, how are you integrating those going forward, and what's your plan to continue to take advantage of what you did right during COVID, and what's that strategic plan? You should have a very well thought out, detailed plan of how you're coming out of COVID. Okay. I'll take you through a little case study for you of a client of ours. This client was called we give all of our clients a project name for confidentiality purposes. This company was called Starfish. It was a consumer product company, had multiple products within a plumbing. It's kind of a plumbing product, I can tell you that much. The owner was 55 years old. He and his wife were empty nesters. They've been making plenty of money for a number of years. They were financially well enough off. They could actually close the doors and walk away if they wanted to, but she wanted to travel more. The goose that was laying the golden egg for so long has now become a ball and chain. So she wanted she more than him, but he was on board with wanting to sell the company as well. As you can see, they're doing 2.1 million in EBITDA. They had some great strengths. They had a diversified customer base. They had phenomenal EBITDA margins for a product company of 50%. Their model was very scalable. Their products were manufactured overseas. They were shipped out of a 3PL location here in the United States to the various distributors. They never touched the inventory. It was all managed and maintained at a third-party warehouse. So the company was very scalable. They had GAAP-prepared financial statements. COVID had no negative impact on their business, maybe even had a slightly positive impact because more people were spending time fixing up home items around their house. And intellectual property. They actually had a number of patents that protected their products. So they had a nice niche, and they were well protected in that. But they did have a major weakness. As I mentioned, it was really a husband and wife team. It was a husband and wife and a bookkeeper. They're the only people running the business. When you saw how scalable and flexible their business was, they didn't need anything more than that. They used independent reps to rep their product to the distributors, and they just had to manage those independent reps, and they could do that themselves. So they had no secondary management team. A big negative there. So we like to take our clients, before we take a client on, we measure them, we judge them based against the metrics. I've only included here about half of what we include on our metrics internally, but these are the 7 items that I've talked about earlier about what makes a quality company. And so what I thought I'd do is take each one of these qualities for a minute and score Starfish for you. Now, by the way, before I do that, this worksheet is available. I believe Mary Jo's going to make it a link available in the chat for you. If you want to link to this, you want to take this chart and grade your own company, I would highly recommend you do so. You can go and get a copy of this chart. It'll also be included in the materials that you can request. We'll upload this presentation, and you can obviously get it from the presentation if you'd like. Okay. So here's Starfish. We graded Starfish based on this model here in our matrix, And so we talked about financials earlier. We gave them on a score of 1 to 10, we gave them a 10. They have audited, small company they didn't need to, but they had their financials audited. So that was a great way to start. But number two, they got the worst score. From the best score to the worst score. This company was totally owner dependent. I mean, if he got hit by a truck, or both of them, and they actually have a private plane. So if they put a crash in a plane crash, it'd be really devastating to this business, right? There'd been nothing left. There was no secondary management team, so they got a 1. Growth and scalability. Their model was very scalable. The way they established offshore manufacturing and the distribution, they could grow very quickly. So we gave them a 9 for that. Barriers to entry, we scored them a 7. We mentioned they had, I think, five or 6 patents on their products. So they had, some good, but they did have competition in the space. They weren't the only players in that space, but they've done a good job of securing and protecting their own products. Margins and profits. As I mentioned, they had 50% gross profit margins on their product. It is phenomenal. And so that was really good profits. Business. And then recurring revenues. Their business model was very fairly recurring revenue stream through this process. So we scored them an 8 on that. So their total score was 52 out of 70. Now 52 out of 70 was, I would say, is kind of be honest, like a B minus score. It's certainly not an A, but the only thing that made it not an A, frankly, or a B plus or A minus, was the owner's dependency. Okay, we'll talk about that a little bit more here as we talk about how we position this company for sale. So you want to say, how did their story end? So they were engaged right in the middle of the pandemic, by the way, which may be a surprise to a lot of people, but June 1st, we were engaged. Now we put them on a fast track model that we use and that we occasionally use. We don't use it for all clients, but some clients in the right situations we do. We put them on a real fast track. They were within 1 week. We had created all the marketing materials. The customer was had everything, had his act together, had all the information ready for us, and we got on it. Within a week, we had approved all the marketing materials, which usually takes a month to do. We had it done in less than a week. Okay, so by June 21st, we were already in the market. We went to market. We'd already been in the market for 2 weeks, and at the end of June 21st, we had 28 non-disclosure agreements signed on it, 6 offers. The valuation ranges on those offers were 6 to 15 million. By July 15th, we had negotiated through all those offers, had management meetings, met with all of them. We did them all remotely, by the way, via Zoom, which is much more efficient. And we ended up accepting an offer for $18 million. That was 8.3 times EBITDA. It was an all-cash offer. Our estimate on value when we went to market was somewhere between 11 to 12 million. So we ended up with a 50% premium over the estimated market value of this business. It sold to a strategic buyer. A strategic buyer. This would not have sold for this type of multiple, most likely to a private equity firm, would not be able to hit their financial metrics. But this was a strategic buyer that had greater distribution capabilities than our client, already had their own distribution channels, their own salespeople, they're a multi-billion-dollar publicly traded company, and it fit beautifully into their model. Now, another reason why we sold to them was because we did not have the secondary management team. We needed that strategic buyer that had the ability to incorporate this into their business without the secondary management team. So it did limit the number of buyers we could take this client to. We really couldn't take it to PE firms because PE firms are investors. They need a secondary management team. With no secondary management team, they'd never do this deal. So again, why did they get such a nice premium? Back to that conversation we had earlier about supply and demand. This was a high quality company, and there were not very many high quality companies in the marketplace in June of last year. And there's still plenty of capital available. And these guys were a little more proactive, meaning the buyer was a little more proactive, saying, I know we're going to come out of this. And I know I see the results from this company not being impacted by COVID. And there's so many great things we can do with this business. It just fits perfectly into our distribution model. So in closing, I number one, appreciate your time. I hope that you've learned something today that has been of value to you, and you found this time with us worthwhile. Taxes. So what, in summary, in closing, taxes will impact the value of your business. I'll unpack the value, impact the amount of money you will take away after and put in your pocket. There's no doubt about that. Number two, be a quality company. Score high on that metrics. If you're not scoring high, figure out how to fix that if you can, okay? Or moderate that, okay? Have a clear post-pandemic strategy that you can articulate quickly and easily to a buyer. And fourth, it takes about 6 to 9 months to take most clients to market and get to a closing. We anticipate that the Biden tax plan will go into effect beginning January 1st, 2022. That gives us basically a little less than 8.5 months from now until then. If it takes 6 to 9 months to sell the average company, we needed to start yesterday. So if you're considering selling your company, you need to start and get it in before the taxes change. You need to consider doing it now. With that, I thank you again for your time. It's been a privilege spending the last 45 minutes or so with you. My name is Robert Hill. This is our contact information on our firm. If you have any questions about anything in this presentation or just want a general consult, happy to take your call. I am a Vistage member here in Seattle, have been for a number of years. And ACT is a platinum national Vistage sponsor, so you may have met you or have seen you at other executive summits around the country. We are a trusted advisor. And so please just feel free to pick up the phone and give us a call. Be happy to answer any questions that you may have. You may also ask questions, I believe, in the comment section. And I believe Bill has been curating questions for us as the presentation has gone along. I know a few people submitted questions in advance as well. So with that, I'm going to turn the time over to Bill.
Thank you very much, Bob. Yes, you can submit questions by typing them into the Q&A section at the bottom of your screen. And let's get started. One of the biggest questions we had, you just answered, which is when do you anticipate the change happening, which would be the first of 2022. But we have several questions asking, hey, is there any chance of capital gains coming back in a new administration in the near future? Or is there any chance that this could be a retroactive tax change?
Okay, let's start with the last question first. Will it be retroactive? Again, this is my own personal opinion. I don't think there's enough will in Congress on either side of the aisle to make it retroactive. Even there's enough, you want to call them conservative blue dog Democrats, that will not side, I think, with the Biden administration in making the tax retroactive. And they haven't requested it be made retroactive either. So my guess is it will go into, it should get passed sometime in this year's legislative agenda, and it should go into effect January 1st, 2022. Now, who has a crystal ball about the future? Well, I can tell, my guess, and I don't think this is brain science, but if we remain with, as long as we're with a Democratic president, along with either with a mixed or even a Democratic Congress legislature, I think the capital gains tax is going to stay with the change. The only way I see that changing is if we get a Republican Congress and a Republican White House with a favorable Republican-leaning Congress, where you see capital gains tax be modified or done away or gone back or changes back to the 20% that we see today. And so you're at least 4 to maybe 8 years, who knows, when we might see that happen again. I don't know it's going to happen in 4 years. My guess is that's early chance is probably 8 years out.
Bob, if you had a $10 million business, would you sell it this year or hold on to it for 5 more years?
That depends a little on your own, personal situation. Um, if you are 65, 70 and looking forward to retirement, sell it today, sell it now. Now's the time to do it. If you're 40, 45 and say, hey, I can hang around another 8 to 10 years. I love what I'm doing. I'm happy what I'm doing. I'm making good money. Then I would say, hold on to it. If you're going to hold on to it for 4 or 5 years, you're going to be better off selling it and still taking the tax hit, right? If you hang on to it for a few years. So my advice is, if you had any idea of selling it within the next couple of years, and I would sell now.
What impact will the infrastructure bill have on this, since a number of senators are trying to, let's call it horse trade tax elements?
Yeah, that's a good question. It actually should have a positive impact, just because they're stimulating the economy with so much money, So anybody involved or tangentially involved in those industries that are going to be benefit, then certainly you're going to see their EBITDAs, their revenues, their earnings are going to go up, and as a result. So that type of monetary fiscal stimulus will have an impact on the monetary stimulus will have a positive impact on the economy.
You mentioned that COVID has had impact on business values. Do you see valuation multiples going up or down in 2021? And how about 2022 and beyond?
Yeah, that's a really good one, and the presentation probably didn't allow for enough time to discuss it. I think we're going to see certainly pressure on multiples to go up in the short term, because there's just so much capital out there. But as you get closer to that deadline of December 31st, I can see some discounting going on. You're going to have sellers are going to be a little more desperate to get the deal closed in order to take advantage of the tax, and you're going to have some buyers out there are savvy enough to wait and try to take advantage of those. So we could see actually some overall EBITDA multiples dropping a little bit in 2020, at the end of 2021, just because, again, it's going to be a big mad dash to get deals closed by the end of the year. Now, 2022, I anticipate, frankly, it's just a tough yin and the yang. You've got so much capital out there, so few quality business to invest it in, but private equity, having come from the private equity world, we still have to take into consideration what's our after-tax cash that we actually get, and we're going to be impacted on corporate taxes as well as impacted on capital gains taxes. So we have to factor that into our models, and we still have to get a risk-adjusted return on our investment to our investors. We're committing to our investors, somewhere around 20% IRRs, and the only way to do that is we can't overpay. And if companies are going to have to pay more and more of their money in taxes, and we're going to have to pay more and more in capital gains, that leaves less to go to investors for their return. And so it's going to bring down my internal rates of return. So I think that to be honest, that these taxes are going to ultimately, maybe not in the next year, maybe next year or so, but ultimately going to have an impact on values, and we're going to see those multiples come down. So that's a conversation I have with some clients. They say, well, I'll wait a year or two and I'll take the tax hit. I say, yeah, but you're not going to get maybe that 7 to 8 multiple that you get today. You might be looking at a 5 to 6. So, maybe your revenues went up and your income went up, and you're going to pay more. You're going to have to almost double. If you look at it, if you think about it, you almost have to double in size over the next couple of years in order to come out the same tax-wise, but after tax money in your pocket. So that's a big gamble.
One of our listeners says a large strategic acquirer had engaged him for initial due diligence, acted very interested, then went radio silent. How often does that happen? They didn't even get to negotiating the price yet. That was the next step.
Yeah. That happens a lot. You get a lot of, I don't want to say tire kickers, out there, companies that are looking, and they pick up the phone, they make a few phone calls, show a little bit of interest. But things change, and for whatever reason, they either think they're going to get a better value. Maybe strategically something's changed for them. Maybe they have a couple of acquisition opportunities that are better, so they're going to prioritize them. This is one of the reasons why, if you really are serious about selling your company, really retain the services of a professional, of an investment banking firm, because if investment banker is going to go out there and he's going to sort through many buyers for you and bring multiple buyers to the table to create a strategic auction for your business, and that'll weed out these weak sisters. That'll weed out these people who aren't as serious as others. And it when you get people competing, it creates competition, a sense of urgency. Things move. People don't go radio silent if they're really serious.
Thank you. Are there any other taxes that outside of capital gains we should be paying attention to, like carbon taxes?
Yeah, I'm not as familiar with carbon taxes and what the impact might be, and certainly that have to impact the type of business that you're in. I don't think most businesses would be that negatively impacted by carbon taxes, but there are other taxes. I mean, the ones we've talked about, the main ones you're going to worry about primarily. Again, what I should caveat is we're not in a CPA firm. We're not tax advisors. But we are an investment bank, and we deal with taxes as a part of our business, so we're fairly knowledgeable. But when you get into your individual situations, and particularly when you get into an M&A process, you want to make sure you're in good communication you have a good tax advisor, number one, and communicate with them. They should be part of your M&A team. We tell people you should have, your tax advisor, your wealth management advisor, and your attorney, and us as your investment banker. Who's experienced in M&A transactions, so he knows the right questions and the right issues and the important ones, and you don't want a divorce attorney or your cousin Joe who's just a basic attorney who hasn't had this experience, right? So that's important. Then, of course, as I mentioned, you want to have your tax advisor, because he's going to help us and discuss the various ways a deal can be structured to minimize your taxes.
My revenues in 2020 were down, writes a listener, but they're back on track now. Will this make it hard to sell my business? And you mentioned this during the workshop. How do I present that properly?
Yeah, so it should not. Each individual situation is different, and I have to look at your industry and so forth. But I'm going to make a big caveat or a big generalization, as I did earlier. There's so much capital out there that needs to be invested, and most if you're large enough, attractive enough to a private equity firm or a strategic, which means you're probably going to have a minimum of $1 million in EBITDA or greater, 2 million preferred and greater, then you're going to attract professional investors, and they're going to look at those numbers, and if they can see that you're back on track, then they're going to ignore that. And hopefully you've kept track in some way in your systems what additional costs you may have had due to COVID, and maybe what business you might have lost due to COVID that maybe now has come back. If you can show those and demonstrate those, and if you're working with an investment banker, they'll help you through that. And we would position that in the marketing documents in the financial section. We'd have a section that talked about the COVID impact and why it should not be considered in the value of the business.
Bob, thanks so much for your insights today. We really appreciate it.
Thank you. Thanks, everyone. Thanks, Bill. Thanks, Mary Jo. Thanks to the great folks at Vistage. And happy year. Everybody have a prosperous year. Glad to see we're coming out of this COVID environment.
And we hope you'll join us next Friday, April 23rd, for the next webinar in the Vistage Peak Performer webinar series. We'll be speaking with Adrienne Cronier, CEO and CIO of Ballantine, about the company in about the economy in a post-COVID world. You can register at vistage.com/webinar. That's vistage.com/webinar. Stay safe, everyone.